For 100 years, there was one clear finish line for an ambitious company. Ring the bell on Wall Street, sell your shares to the world, and officially make it go public. But look at the most valuable companies on Earth right now: SpaceX, OpenAI, Stripe. Each worth hundreds of billions. And every one of them has refused to do it. They could go public tomorrow. The bankers are begging them. They're choosing not to. The trophy that every company used to chase, the best ones now actively avoid. And it's not just the giants. The number of public companies in America has roughly halved since the 1990s. The public stock market is quietly shrinking. So what happened? Why would a company turn down the world's money? And here's the part that should bother you. Where did all the good investments go? Let's follow it. First, the basics. What does going public actually mean? For most of a company's life, it's private, owned by its founders, employees, and a small circle of investors. An IPO, an initial public offering, flings the doors open. The company sells slices of itself, called shares, to absolutely anyone. You, me, a pension fund in Norway. Those shares start trading on an exchange, like the New York Stock Exchange. Hence the famous photo, founders on a balcony, ringing a big brass bell, confetti everywhere. For decades, that bell was the rite of passage. It meant you'd arrived. It was how a startup became a real, grown-up institution. So, if it's such a triumph, why are the crown jewels of the modern economy all refusing to ring it? 3 things changed. To see what changed, you have to know why companies went public in the first place.
It came down to 2 simple needs.
Need 1, money. Growing a company costs a fortune, and for a long time, the public market was the only place big enough to raise it. Hundreds of millions, even billions, in one go. Need 2, a payday. Founders and employees hold shares worth a lot on paper. But you can't pay rent with paper. An IPO turned it into real, spendable cash. For most of the 20th century, the public market was the only door that led to both. Big money and a way to cash out. If you wanted to get huge, you basically had to walk through it. That was the deal. And in the last 20 years, every single piece of it quietly fell apart. Change number 1, the money. It turns out you no longer need the public's money, because there is now an ocean of private money sloshing around. Venture funds, private equity, sovereign wealth funds from entire countries. They're sitting on trillions of dollars they need to put to work. The industry's nickname for it is dry powder. A company like SpaceX doesn't need a stock market to raise $10 billion. It just calls a few of those funds, and they wire it over. No IPO required. So the first reason to go public, needing the money, basically evaporated for the top tier. The private piggy bank got so big it swallowed the reason. OpenAI, valued in the hundreds of billions.
Stripe.
ByteDance. Some of the biggest companies in the world have grown to staggering size without ever selling you a single share. Change number 2, being public turned into a genuine headache. The bell comes with a very long list of strings attached. Once you're public, you live and die by the quarter. Every 3 months, you must report your numbers. And if you miss by a hair, the stock gets punished and the headlines turn brutal. That breeds short-term thinking. Hard to spend 5 years on a big, risky bet. When the market screams at you every 90 days for a result, patience becomes a luxury you can't afford. You also have to open your books to customers, employees, and your direct competitors. Plus armies of lawyers just to stay compliant. Expensive and exposing. And then come the activists, investors who buy your stock, specifically to pressure you and reshuffle your board. Staying private means nobody storms the boardroom. Change number 3 is the quietest and maybe the most important. The old payday problem got solved without an IPO at all. Remember, employees needed a way to turn their shares into cash. Now there are private marketplaces, names like Forge and EquityZen, built for exactly that. On these platforms, an early employee can quietly sell some of their private shares to a big fund and walk away with real money. A side door to liquidity, no bell required. And that removed the last big pressure valve. The thing that used to force companies public, everyone clamoring to cash out, could now be handled privately in the dark. So, add it up. The money, handled privately. The payday, handled privately. And the burdens of being public, avoided entirely. The whole case for the IPO collapsed. Now look at what that's done to the public market itself. It is measurably getting smaller. In the mid-1990s, the United States had around 8,000 public companies. Today, it's roughly 4,000. The market that's supposed to represent the economy has lost about half its members. And the ones that do eventually go public wait far, far longer. Decades ago, a startup might list after 4 or 5 years. Now, many wait 10, 12, even more. Whole years now go by with a trickle of IPOs. In 2025, the entire biotech industry managed only about 11. For a sector that lives on raising money, that's close to a desert. So when companies finally do ring the bell, they're enormous. Fully grown, often past their wildest growth, which leads to the question that should worry every ordinary investor. Here's who actually loses when companies stay private. You, the regular person with a retirement account and an index fund. Think about where the spectacular returns happen. A company going from a startup to a $100 billion giant. That's the 10 times, 100 times run. The part that builds real fortunes. Almost all of that explosive growth now happens while the company is private. Locked behind a velvet rope, open only to venture funds, insiders, and the already wealthy. By the time a company finally goes public, the easy, jaw-dropping gains are mostly gone. The early backers already cashed them. What's left on the public menu is the slower, later, riper stage. And that's the real flip. The IPO used to be the starting line for public investors. Now it often looks more like an exit door for the insiders cashing out and handing you the keys at the top. Now, before you assume this is permanent, it isn't. This whole private boom was built on one thing: incredibly cheap money. For over a decade, interest rates sat near zero. When money is nearly free, giant funds will pour it into private companies for years, no questions asked. That fire hose is exactly what let the best firms skip the public market entirely. But raise interest rates, the way the world did in 2022, and that fire hose narrows fast. Suddenly, private cash gets expensive and picky. When the private money tightens, companies that stayed private too long get pushed right back toward the one buyer big enough to catch them. The public market. So the bell isn't dead. It's cyclical. Cheap money empties the public market. Expensive money refills it. The tide just happens to be all the way out right now. So the bell still rings now and then. But the center of gravity has moved decisively behind a velvet rope that most of us will never get past. Going public flipped from a beginning into a late, optional exit. The trophy became a chore, and the best growth quietly slipped off the public stage and into a private room. The stock market once was the economy. More and more, it's just the part of the economy they're finally willing to sell you after the most exciting chapter is already over.